Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Today, Chris Osmond is behind the microphone. First time running the mic. Chris, how are you?
Ark, I'm great. It's great to be here. And I'm excited to kick off my inaugural Centura Wealth Advisory podcast with you and our esteemed guest, Paul Kaseburg, to discuss such a relevant topic in today, inflation and multifamily real estate. Today, we're going to discuss how real estate protects against inflation, as well as dig into how interest rates and inflation are impacting multifamily real estate today. Now, before I introduce Paul formally and get us started, I wanted to provide a brief background and introduction to myself. So as you mentioned, my name is Chris Osmond. I'm the new Chief Investment Officer here at Centura Wealth Advisory. So as Chief Investment Officer, I'll be drawing on my nearly 20 years of experience managing investments for successful families and high net worth investors, ultra high net worth families for some of our nation's largest financial institutions, as well as my experience previously serving as a chief investment officer for a $17 billion registered investment advisor, just like Centura is. Now, so I'll be looking to guide the overall investment philosophy, as well as build and manage unique investment solutions and developing a robust alternative investment platform to help ensure Centura's clients are equipped with the proper tools in order to help meet their financial goals and objectives. But that's enough about me. So before us, I'm very fortunate to introduce our guest, Chief Investment Officer of MG Properties, Paul Kaseburg. Now, for our clients listening, odds are you're familiar with MG Properties. But for those who are not familiar with MG Properties, they're a premier commercial real estate operator specializing in multifamily real estate. And we just are so fortunate enough to have them headquartered right here in our backyard of San Diego. So without further ado, Paul, thanks for joining us. It's an honor to have you, and I'm excited to dig into our topic today. But before we do, will you please provide our listeners with your background as well as a little more formal introduction to MG Properties?
Sure. Thank you, Chris. And thank you so much for having me on the podcast. I've been enjoying listening to it, so it'll be a lot of fun to have the conversation today. So my name's Paul Kaseburg. I am MG's Chief Investment Officer, as you mentioned. So a little background on MG. MG is a 30-year-old owner-operator of multifamily properties. So we have, throughout our history, only purchased and operated multifamily properties. We're specialists in that space. We're vertically integrated, so we handle all our own property management, construction management in-house here based out of our San Diego office with regional expertise throughout all of our regions. We have about 27,000 units from Denver West, and we have concentrations in most of those major markets. I have been with MG since 2010. My background is I was an engineer out of undergrad. I worked on satellites for a while and did corporate M&A at Northrop Grumman. And then I got into the real estate business, and when the dot-com bust hit and I was doing in-house venture capital, that opportunity was going away for a little while. And I had some friends in the real estate business, and they said, you should give this a try. It's all the things you like about venture capital are present in real estate. So I gave it a try, really enjoyed it, and I've been in real estate for a long time. Joined MG, as I said, in 2010, just as we were coming out of the financial crisis. And it has been a tremendous run in the apartment business since then.
That's a great story, Paul. Thanks for sharing. And without further ado, let's get started talking about today's topic. And I want to start by giving a little bit of framing on today's current environment. We're certainly in very precarious times. We're facing an economic environment that is nothing less than tumultuous. We're going on 100 days of a war between Russia and Ukraine. China's still battling to find economic footing as they continue to deal with widespread shutdowns as a result of COVID outbreaks. The equity markets have sold off significantly, with the NASDAQ now more than bear territory and almost beyond its drawdown that it experienced in COVID. we're experiencing one of the worst starts to the year in the equity markets. And they're not alone there, right? Interest rates have spiked, where the 40-year bull market that we've experienced with bonds, well, that's over. And if the year were to end today, this would be the worst year on record by more than fourfold for bonds. So it's been very rough for asset allocators, investment managers that have really leaned on diversification, for investing on behalf of their clients. Now after almost 2 years of the most expansive fiscal and monetary stimulus we've ever experienced, that well is starting to run dry. The government has stopped stuffing bank accounts with COVID-induced stimulus checks, and the Federal Reserve has finally stopped buying bonds at a clip of $120 billion a month. Rather, now they started tightening monetary policy and raising interest rates, and we're starting to reduce their balance sheet in June, all in hopes of curtailing inflation, which is one of our primary topics today in the podcast. Now, speaking of inflation, we're looking at 40-year highs. CPI is running at 8.3% through April. And though anyone that you've talked to, I mean, I'm sure, Paul, you've experienced as well as Art, you go to the grocery store, you fill up your tank at the gas pump, it definitely feels like prices have gone up more than 8%.
Yeah.
Just for instance, if we look at that April's CPI report, the largest variable, makes up about a third of CPI, is shelter. So that would be like rent, home prices, things of that nature. Well, rents are up, nearly 16%, and price of homes over almost 20% year over year. Yet rents are up 5%. So I feel inflation is actually somewhat underreported.
Yeah.
But I'll digress. At the end of the day, no one really likes inflation, right? It erodes the value of our assets and ability to purchase goods. If you think about it, $100 today is going to purchase less goods than $100 will in 5 years from now. So while inflation is not really a welcome happening, there are ways to hedge against that erosion. And that's what really I want to switch gears and start talking about now. And perhaps one of the strongest ways to combat inflation is by investing in real assets like real estate. So, Paul, why is real estate such an effective tool to hedge against inflation?
Yeah, well, I'll talk about that, but I can't help myself. I have to kind of weigh in on your comment about inflation being a little bit lagging right now, because, you mentioned that shelter is the biggest component of that. And if you take shelter and food and transportation, I mean, those together are about 75% of CPI, right? And so, the food and transportation, those have been kind of leading the headlines in terms of what people are feeling, the inflation. But as you mentioned, rents are up very substantially. I mean, in a lot of our markets, we're talking about 20 to 30% increases in rents. And we'll talk about this, but those rents not all of the residents who are in those properties have been reset to today's market rents. And so the components of that shelter are not reflecting where rents are today. There's some catch up just to get to today's rents. And so I fear that there's more to come on the shelter portion of that CPI number, which, like you said, is the biggest part of it. And it's obviously it's not great to have inflation as high as it is. Inflation's eroding the value of the dollar. At the same time, disinflation, typically when we think back to the times where there's been big disinflation, that equals the times where we had major recessions. And so that's not, not good either. And so the Fed's in this kind of difficult situation where they're going to have to thread the needle, right? With,
absolutely.
I don't envy the folks at the Fed. So I think they used to be trying for a soft landing. I think now they're trying for a soft-ish landing, right? And they're just trying not to crater the economy, try to get their arms around inflation, and we certainly wish them well. But in the meantime, so you asked about real estate and how it responds to inflation. And I think over the long term, generally, real estate is one of the havens for investors who are looking for some shelter from inflation. So, I kind of think about, as an investor, the two things that I generally worry about are an economic downturn where the fundamentals of my investment are eroding and the demand's falling away, or an inflationary situation where just the value of that dollar is eroding. And like you said, it's been 40 years since we've really had the latter. But what we've had in the last 2 years is first COVID hit and you had the former, and now the latter is hitting and we're having inflation. And so you have this double hit that has been impacting the economy. And so I think as inflation has picked up, investors appreciate that when you're in real estate, over the long term, the rents that you get from that real estate adjust up to reflect the weakening value of the dollar as inflation hits. So real estate generally tends to be a haven for folks who are looking for something that's going to respond to inflationary times. But not all real estate's necessarily the same in that respect. So, I mentioned that multifamily rents, not all of those residents have been marked to today's market rents, but our lease terms are usually about 12 months-ish. And so they're relatively short in the world of real estate when you compare them to triple net investments or office investments, industrial investments that are more like 5 or 10 years or even longer. So for those investments, they do reset, but it may be 10 years before you get a real reset that reflects then market rents. And so they have actually been hurt by the jump in inflation and the jump in interest rates, which I'm sure we'll talk about, whereas multifamily resets a lot faster. And so I think of the different types of real estate, generally investors like to focus on multifamily. I mean, over the long term, they all reset, but like Keynes says, in the long term, we're all dead.
Yep. Very, very, very true. I often hear that multifamily is often considered not recession proof. I don't think really anything's recession proof, but often recession resilient. Can you speak to that a little bit, Paul? Why is it that multifamily, especially perhaps in today's environment, would multifamily be considered more recession resilient than perhaps other types of real estate?
Yeah. And again, I think the last 2 years have been a real case study for why that is. So when COVID hit, in fact, maybe it's worth talking about a little bit longer view on multifamily as an investment class, right? So if you go back about 25 years over the longer term, how has multifamily worked as an investment? And it's been our average returns for multifamily on an unlevered basis have been kind of in the 9 to 10% range on average over the last 25 years. And you can go get that data from NCREIF, some other online sources. So that's on average. When you compare that to other asset classes, it's in the ballpark. They tend to be in that kind of 8 to 9.5 range. But multifamily is on the high side. What's notable is the standard deviation of our returns is actually pretty low in comparison to other asset types. And so multifamily, when the economy drops, doesn't drop quite as far. And then as it recovers faster. And so that's, I think, one of the reasons why investors see it as being inflation resistant. What we've seen since COVID hit over the last couple of years is COVID hit and demand just fell off a cliff for things like office because everyone was working from home, retail. The two kind of standouts in terms of real estate investments were multifamily because everyone still needs a place to live. And by the way, they probably are less inclined to live with a roommate during COVID. And then the other investment class that did well was industrial. And that really reflected all the trend toward shopping online during COVID. So those two asset classes did well. And now that inflation has hit, what you've seen is some of the industrial assets have struggled because of those long lease terms. But again, multifamily structure with those short lease terms have meant that it's done pretty well since this inflation started kicking in comparison to other types of assets. So generally, just the fact that multifamily is people's homes. It's just the demand side from residents for multifamily is just a little bit less variable than it is for commercial assets.
Great. No, I agree. Agree completely. If we shift a little bit, we talked a little bit about how multifamily real estate can help hedge against inflation. I want to switch a little bit and talk about how inflation is impacting the multifamily housing market today. We're seeing rising input costs across the board, right? From raw materials to labor. And I'm curious, how has this impacted MG properties as you're looking at opportunities to either acquire or even dispose of an asset?
So inflation, we're feeling it in the multifamily industry, just like everyone is. In theory, inflation impacts everything. What we've seen so far with this inflation is that a lot of prices are going up, but it's not uniform across all goods and services. So specifically on the cost side of the equation for us, the construction costs are up. So lumber is up, steel is up, asphalt's up, kind of all in the range of 25 to 50%, which is extremely substantial. And then labor is getting more expensive. And so that impacts both the development side of the business and us. So we don't do ground up development. We just do existing properties, but our payroll is up since we self-manage. And so that's definitely impacting us. Some other costs are up too. Things like digital marketing has been an increase for us. Our R&M costs have gone up. So overall costs have gone up. I think it's really impacted the development side of the business more substantially. And as those construction costs go up, both the labor and the materials, that's going to slow down the construction pipeline. And that's going to slow down that delivery of new product. That means less competition from new apartments for existing apartments. And hopefully that helps to support rents. On the revenue side, we felt the effects of inflation, and that is really, there's been a lot of household liquidity with a 40% increase in M2, right? And so that's distributed out pretty widely to residents, disproportionately, I think, to lower income residents who also tend to rent. And so renters have been in a pretty strong situation, both with stimulus and also with wages going up. And so that's been reflected in the growth in rents. That's up about 15, 17% above where it was pre-COVID. And so if everything on the revenue side and the expense side went up equally with multifamily, that would actually cause values to go up because our expense ratios are only, 35, 45%. So our NOI goes up disproportionately and then values go up. So inflation, by itself, because of the cost structure of multifamily has been pretty helpful. And so we've been seeing that so far.
No, that all makes sense, and I remember when, I probably, you can correct me if I'm wrong here, but what was it, maybe 5-7 years ago, where cap rates at 7% were considered cheap, right? Right now we're looking at 4 on average cap rates in multifamily. And when you factor in the cost of debt, a lot of the opportunities that we're looking at, a lot of operators are starting out with essentially negative leverage out of the gate on new opportunities because that cost of debt is higher than their cap rates. How has that impacted MG Properties business in this current environment, as well as those underwriting assumptions?
We have absolutely seen that, right? So the story of many years in this business has been the steady decrease in cap rates. And that's started to turn around with the increase in interest rates, but it hasn't changed substantially yet. So I think there are 3 big stories in the multifamily industry, which, over the last 18 months has been nothing like anyone's seen, in their careers. So the 3 big stories are 2021 rent growth was just incredible. 2021 cap rates dropped substantially. And then 2022 inflation and sort of concurrently mortgage rates increasing, right? And so those 3 things are all tied together. And to take the cap rate portion of that specifically, it's actually really interesting to look at what's happening there, because the cap rates are a reflection of the incredible growth in rents that we saw. And so what happened was rents grew so fast when we were looking at properties that we were considering buying. The rents that were in place are substantially below, perhaps 15, 20% below where current market rents were. at certain points last year because the rents just moved up so quickly. So you had what we call loss to lease, which is this revenue loss, a difference between where the rents are in the current rent roll and today's market rents. And so the cap rates dropping so fast were really reflecting the fact that there was this big loss to lease. And if you just continued to rent units at today's market rents, your revenue was going to go up really substantially over the course of the next year or two. And so what's kind of interesting about those really low cap rates, and when you compare them to negative leverage times in the past, were, for instance, before the financial crisis, right? So before the financial crisis, you had negative leverage and really low cap rates where investors were believing that the future was going to be amazing and it was going to keep being amazing for many years. They were believing in this future growth. Whereas last year, those really low cap rates, some of it was a belief in growth, but a lot of it was a belief in what already happened in the past and just that coming up to today's market rents. So it's kind of a looking back versus a looking forward. So kind of an interesting dynamic last year that we just have never seen before. And then this year with interest rates going up, it's been really substantial. So interest rates, just for context about where rates have been through COVID. So COVID hit and values of multifamily really did not decline substantially. The transaction volume went down for a couple of months while everyone was working from home and figuring out where values were. But what happened was the mortgage rates for multifamily, along with the 10-year treasury, dropped. And so when we saw that, we tried to get back into acquisitions as quickly as we could after COVID. We did about $500 million of acquisitions in 2020, and we started in the second quarter, and we locked our first deal at a 2.35 fixed 10-year full-term interest-only rate, which is just tremendous in the context of where mortgages are historically. So we saw this opportunity. We tried to take as much advantage of it as we could. The rates started to increase. And in 2021, for most of the year, we were looking at interest rates that were kind of in the mid threes. Today, what we're looking at is interest rates that are closer to the mid fours for most borrowers. And so with interest rates in the mid fours and cap rates at, call it 4, you have this negative leverage situation. So I think when I see that, I try to ask myself, what do investors believe that's causing them to transact with these metrics, right? And I think that dynamic of negative leverage is a reflection to me that investors are saying, I'm expecting inflation and also rent growth to increase over the course of the next couple of years. And so the fact that I'm locking in today's negative leverage, when you get that inflation and growth over the next couple of years, that's going to turn positive and make this a solid cash flowing investment. And so I think that's the mindset that investors have in the current environment, is they're looking at this potential inflation and saying, it makes sense for me to start with some negative leverage because I'm going to grow my way out of that. I think that's what's happening in the market. The other factor that's probably worth mentioning is that debt is not the same for everyone in the multifamily space or the commercial real estate space. So multifamily benefits from really exceptional capital market situation because we have Fannie and Freddie who lend. Mm-hmm. And so generally lenders like lending on multifamily because it is, again, kind of considered the safer asset class. And so they're pretty aggressive with it. And we have these GSEs that provide really attractive debt into the market too. So you saw in the financial crisis and during COVID, the GSEs were there, kept lending with attractive financing. And so multifamily was much more liquid and the prices went down much less than other types of asset classes. And then within multifamily, not all borrowers get the same rates too. So MG is a preferred borrower with Fannie and Freddie and some other lenders. And so that can have perhaps a 30 basis point difference in the mortgage rates too. So that also helps out.
Yeah, no, I mean, it's interesting hearing you talk that while real estate is such a great inflationary hedge, that doesn't mean that the industry as a whole doesn't still experience challenges as a result of inflation. Just hearing you talk, that started ringing really, really loud. Talking about interest rates, and how mortgage rates have responded year to date. We've seen home prices up 20%. year over year. And the 30-year mortgage, which happens to be tied, big misconception, it's not necessarily tied to the Fed raising the Fed funds rate, which when they say they're raising rates, that's what they're doing. That's basically the overnight borrowing rate. The 30-year mortgage is much higher, it has a much higher correlation to the 10-year treasury. And as such, while the 10-year treasury has spiked, nearly 2% year to date, 30-year mortgages have spiked more than 2% year to date. And so again, back on the heel of that 20% price increase of homes, we've seen home affordability, those are the two prominent variables when you look at home affordability, reach the lowest since 2007. With home affordability so low as a result of home prices increasing so much, as well as interest rates, what does this mean for multifamily housing going forward?
It is really, again, such an unusual situation, right? Like you pointed out. I mean, home affordability, affordability has been one of the key metrics that we really try to track in our markets. And that's been one of the reasons why we were really bullish on the Sunbelt states and why I think they saw so much growth. It's actually interesting to see them become a lot less affordable since COVID with all the migration from kind of core coastal markets out to the Phoenixes and Vegases and Texases. And so that affordability on both the apartment side and the single family side have really been tough. So since before COVID, in kind of rough numbers, personal incomes are up about 15% and home prices are up about 40%. And then you layer on the fact that the 30-year mortgages went from 3% to 5% or higher, right? So that has just crushed affordability on the single family side. And I think what we're seeing is that's causing a lot more people to be renters by necessity because they just can't afford single family homes right now. And that has been a tailwind for the rental market. And I think that has been a contributor for sure to last year's growth and also to, I think, the growth that we're seeing this year as well. So I think, I think that growth in asset values is just not sustainable, right? Because you can't perpetually have 15% income growth and 40% expense growth. Those things will ultimately end badly, right? So
right.
It's going to moderate. And I think on the single family side, we expect those prices to slow down in terms of they're just not going to grow as fast. And I think, on the rental side, we expect rents to moderate as well. They've been growing at an unsustainably fast pace, and we expect that growth to slow down, not necessarily for rents to go down. So, I think that's inevitable. I think what we have noticed is the affordability gap between single family and apartment renting has spiked. So it's about on nationwide, something like $750 a month more cost to buy a home than it is to rent an apartment. And so that's about twice what the normal gap is between the two. So it would, home prices and mortgage rates would really have to go down for it to be more attractive to buy a home than to rent an apartment. So I think that is going to continue to be a little bit of a tailwind for our industry.
I would definitely agree. And with that gap narrowing, do you ever foresee a period of time, at least in the immediate future, let's say immediate being over the next perhaps 3 to 5 years, where the rent affordability falls below home affordability?
I think there's such a big gap right now because of the high cost of buying single family that it would just take a tremendous drop in values in single family to make it more attractive to buy a home than rent one. So it's not impossible, but I think we're a long way from that world.
Okay. I've got one more question for you, Paul. We've talked a lot about inflation today, and I think we can all agree we're well beyond the, I'll use air quotes here, transitory impact of inflation. And we're staring down the barrel of a gun of the Fed, and they are gung-ho on doing anything and everything to control inflation and essentially cripple it. And so with that, some may question whether they missed their chance to invest in real estate and use that as an effective hedge against that, the inflationary pressures. What words of wisdom might you bestow on those investors?
Yeah. Well, I think, look, that just sort of illustrates why we have negative leverage right now, right? Is that kind of investor mindset of where the world is headed. Obviously, the best strategy would be to go back in time 2 years and buy apartments then. But I think even with the increase in values of apartments, the way that we look at it is, how does that compare with other investment alternatives? So, apartments with cap rates around 4%, you compare that to the kind of yields that you get from an investment in the equity market, which is somewhere in the 1.4% range, right? And kind of bonds, obviously vary widely, but overall kind of sub 3% for kind of a diversified bucket of them. So when you look at 4% for an asset that has the ability to reset with inflation up and acts like a nice inflation hedge, it has some attributes of equities and some attributes of bonds. That feels pretty good. And so I think that's why we're hearing from our investors that they're still very excited to allocate more to multifamily. So we take the view that we're really long-term investors. We're not short-term traders. We're in this for the long term. Our strategy is we buy good real estate that's well located. We try to use moderate leverage. And 10 years from now, when we look back on it, time has shown that if you can hold good real estate for a long time, you generally are happy with that. So I don't think that mindset has really changed. I think, for investors who are deciding what to do, I guess, and I think about this the same exact way, is you look at your portfolio and you think to yourself, what is the appropriate allocation for real estate and multifamily in a correctly diversified portfolio? And if you're not allocated correctly, then you reallocate to be, in line with your objectives. So I guess my recommendation would be to find an excellent wealth advisory firm who might be able to point you in the right direction and work together to come up with a plan.
Yeah, no, Paul, I think you said it very well. And which is why probably Centura and MG Properties are so aligned, because we share so many similar philosophies as it pertains to long-term investing. And I know our clients have benefited greatly from the strategic relationship and partnership that we have with MG Properties. So I want to thank you for that relationship and for everything you do on behalf of Centura, as well as for our clients. And I also want to thank you so much for coming on today and talking about inflation and multifamily housing. It's been an honor to have you. So thank you.
Well, thank you so much for having me on. It's been a lot of fun, and looking forward to the next time.
Gentlemen, this has been fantastic. I love all the information and the very subtle hint about Centura. That was subtle. But thank you so much. Again, Paul, thank you for being on the show. I just want to echo what Chris said. You brought so much value to it. And Chris, great job. First podcast. You navigated it well. You hosted it beautifully. So thank you for facilitating this. And of course, our last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.